It was a chilly November in 2024, and for many Russians, the cold was creeping into their bank accounts. The ruble suddenly went into freefall, losing 10% of its value in just 2 days. It was the sharpest collapse since the early days of the Ukraine invasion in 2022. For anyone with savings in rubles, it was a gut-wrenching moment. Imagine waking up to find your money is suddenly worth much less. That was the reality for millions. The ruble had lost nearly a quarter of its value since summer, and the cost of everything imported was about to skyrocket. The government tried to project calm, but panic was everywhere. The immediate trigger? A fresh wave of US sanctions, this time targeting major Russian banks still connected to the global system. The news sparked a frantic rush to buy dollars and yuan as people scrambled to escape the ruble before it fell further. It was a classic bank run, but instead of cash, people were fleeing the currency itself. For 2 years, the Kremlin had tried to build a fortress economy, rerouting trade and propping up the system. But the late 2024 collapse showed the fortress had cracks. The foundation of Russia's economy was shaking, and the tremors were just beginning. This was more than a number on a screen. It was a stark reminder of Russia's economic vulnerability. The economic war had entered a new, more painful phase for Moscow. The ruble's nosedive was triggered by a new, aggressive set of American sanctions. For years, banks like Gazprom Bank had kept Russia's financial arteries open, handling crucial energy payments. In late 2024, the US finally severed those arteries, cutting off Gazprom Bank and others from the global system. Suddenly, the inflow of foreign currency slowed to a trickle. Companies relying on these banks for international business were thrown into chaos. The move sent a clear message: no part of Russia's financial system was safe. With fewer dollars and euros coming in, the ruble's value plummeted. Demand for foreign currency soared, but supply was choked off, a perfect storm for a currency crisis. The Kremlin's reassurances rang hollow as panic set in. This escalation marked a strategic shift. The West was no longer just fencing Russia in, but targeting its economic lifelines. By hitting previously untouched banks, the US and its allies showed they were willing to inflict maximum pain. The ruble's collapse was no accident. It was the intended result of a calculated economic strike. The pressure on Moscow was now relentless. For decades, oil and gas were Russia's financial lifeline. But by late 2025, that gusher was drying up. Revenues were projected to fall by 35% in a year. Russia was forced to sell oil at steep discounts, especially to new buyers like India and China, who demanded lower prices. India even slashed its imports, fearing US sanctions. Russia was losing customers and selling its most valuable product at bargain prices. Meanwhile, the cost of imports was rising, creating a painful trade imbalance. The trade surplus was vanishing, and the country was getting poorer month by month. Inflation soared as the ruble fell, with annual rates nearing 9% by the end of 2024. The central bank hiked interest rates to 21%, but it was like fighting a forest fire with a water pistol. High rates risked choking off what little growth remained, threatening a deep recession. The financial squeeze was everywhere: shrinking revenues, rising costs, and a currency in freefall. Russia's economic engine was sputtering. The oil and gas safety net was unraveling. The Kremlin's options were narrowing fast. The era of easy energy money was over. With the West shutting Russia out, Moscow turned to China for help. China stepped in, not out of charity, but to seize a strategic opportunity. Beijing became Russia's biggest oil customer, buying at massive discounts. Since the war began, China has saved over $20 billion on cheap Russian oil. But while Russia sold cheap, it paid a premium for Chinese goods, especially high-tech and industrial components. Prices for some Chinese imports nearly doubled between 2021 and 2024. Russia was caught, selling low, buying high. This dependence gave China enormous leverage. Russia was no longer a partner, but a client state. Every major Kremlin decision now had to consider Beijing's reaction. China became Russia's banker, supplier, and economic overlord. The no-limits friendship was looking very one-sided. Russia escaped the West's orbit, only to be pulled into China's. The balance of power had shifted decisively east. China's influence went beyond oil. It now dominated Russia's financial system. As Western banks fled, Chinese banks took over Russia's international payments. Most foreign trade now ran through Chinese banks and settled in yuan. This gave Beijing the power to approve, block, or dictate the terms of Russian transactions. If China wanted to pressure Moscow, it could simply slow or halt payments. Russia had swapped one dependency for another, this time even more concentrated. In May 2025, Russia tried to issue Yuan-denominated bonds in China to raise cash. Beijing refused, denying Moscow a crucial financial lifeline. The message was clear: China would help, but only on its own terms. Russian exporters, forced to accept yuan, couldn't easily convert it to dollars or euros. They had to use yuan to buy Chinese goods, creating a closed loop that benefited China. The yuan became Russia's de facto reserve currency. The system was designed to pull wealth and influence from Moscow to Beijing. China's grip on Russia's economy was now ironclad. The price of survival was growing dependence. While China tightened its grip, Russia's banks were rotting from within. Exporters faced shrinking demand and lower prices. Businesses at home struggled with high rates and falling spending. Bad loans soared. By October 2025, overdue loans hit 2.3 trillion rubles. A Kremlin-linked think tank warned of a systemic banking crisis by autumn 2026 if troubled assets crossed 10%. Even state giants like Russian railways were drowning in debt, forced to cut costs and jobs. The wave of bad debt threatened the entire corporate sector. The central bank insisted everything was under control, but the numbers told a different story. Bad debt was growing at an unsustainable rate. The very policies meant to keep the economy afloat were eroding the banking sector's foundation. The system was flashing red. The cure was becoming as dangerous as the disease. Russia's financial stability was hanging by a thread. The countdown to crisis had begun. As trust in the ruble and banks eroded, Russians changed their behavior. Between July and September 2025, they withdrew 659 billion rubles in cash, a five-fold jump from the previous year. People feared internet outages and new government controls over bank accounts. Financial privacy was vanishing, and confidence in digital money collapsed. The move to cash was a step backward for Russia's economy. Years of promoting digital payments were undone by fear. This wasn't just paranoia, it was a widespread trend. The trust that holds a financial system together was unraveling. As more people pulled cash, banks faced new strains. Mass withdrawals reduced banks' ability to lend and operate. Another crack appeared in Russia's fortress economy. The government could control corporations, but it was losing the battle for its citizens' trust. The financial system's foundation was crumbling from within. By early 2026, Russia's economic future looked precarious. A banking crisis, deepening budget deficit, and tougher sanctions loomed. The Kremlin's options were shrinking fast. The war was draining the budget. By year's end, the deficit was projected at nearly 6 trillion rubles. Cut off from global borrowing, the government resorted to disguised money printing, a recipe for hyperinflation. The EU and UK were preparing new bans on Russian gas and related services, closing off vital revenue. Each new sanction was another brick in the wall around Russia's economy. A systemic banking crisis by late 2026 seemed likely. The National Wealth Fund was running low, and reserves weren't infinite. Russia was running out of road, and the economic cliff edge was near. Russia has maneuvered itself into a perilous economic trap. The ruble's collapse was a symptom of deeper problems: decades of oil dependence, war costs, and crippling sanctions. The Kremlin's financial fortress has failed. Instead, Russia is now dependent on China. This is not a partnership of equals, but a desperate seller and a savvy buyer. Russia sells oil at a discount, pays a premium for Chinese goods, and transfers wealth to Beijing. China controls Russia's trade channels and sets the terms. By refusing to let Russia borrow, China made its limits clear. Inside Russia, bad debts pile up, citizens hoard cash, and inflation bites. The government is forced to print money, fueling more pain. The tools to fix the crisis, borrowing abroad, attracting investment, are gone. Russia faces internal collapse and external control by Beijing. Its future is no longer written in rubles or dollars, but in yuan. The price of defiance has been the surrender of economic independence.